Digital banking, a form of banking that conducts its services online and also communicate to its customers through digital channels for their day-to-day financial activities. Its benefits include 24/7 access, better customization, and faster transactions. Just like my filled piggy bank to my negative bank balance, change is inevitable. And for digital banking, this is a change that enhances competition and innovation within traditional banks in order to serve customers better. Hi, I'm Kevin, and this is my video on how non-financial disruptors can impact the financial industry following MES decision of issuing 5 digital banking licenses. So, just like my spending habits is not clearly sustainable, we can segue to the first part of the video, which is sustainability. You see, MES specifically state that the organization that applies for this digital banking license must have a sustainable digital banking business model. Now you may ask, what is this sustainable digital banking business model? Well, to put it simply, is when a bank uses digital technologies to enhance its products, services and processes while having new innovation, managing its regulations and expenses in order to increase revenue overall. For example, getting access to your personal credit while browsing an online store is one of the potential products that can attract new consumers. This is by enhancing customer experience, by integrating financial services into non-financial services seamlessly. So what happens if a digital bank does not have a sustainable digital banking business model? Well, for one, it will not last long or far in the future. This is because not being sustainable means that you're not utilizing your resources efficiently in order to achieve your financial goals, like strong profit or revenue. This means that because they can't keep costs down, they are unable to scale up or expand, and thus, they are not able to meet their long-term financial objectives. Another issue is that it is not able to sustain customers and investors as they are not able to keep their products updated in order to fit their needs. One example is Kodak. No, not this Kodak, this Kodak. A photography company that failed to keep up with the trends and innovate new products, thus filing for bankruptcy in 2012. This will result in lower revenue as there is lesser customers and investors that are interested in the bank. For the second part of this video, I'll be explaining of how the issuing of these licenses may impact the futures of the financial industry in Singapore in relation to Hong Kong. The reason of having digital banks is to allow Singapore to remain competitive as a financial hub in the world, especially since we are ranked 4th. So the first change that may happen is how digital banks can help Singapore traditional banks digitalize from competing with each other in order to serve customers' needs. They want digital banks to be well established and well funded in order to have the capabilities to push traditional banks into digitalization. This can be seen with MES setting of the capital requirements being more extensive than Hong Kong, with needing 1.5 billion Singapore dollars for digital full banks and needing 100 million Singapore dollars for digital wholesale banks, while in Hong Kong needing only 300 million Hong Kong dollars or 53 million Singapore dollars for their digital banks. These digital banking applicants, which are agile technology companies, already put pressure on traditional banks to digitalize. This is because they're already serving the needs of customers outside of their banking sector while investing in customer-centric products like seamless integration of financial services into non-financial services, which 66% of customers want according to a survey. Thus, Singapore in the long-term future will have a stronger financial system. This is because of how these traditional banks and digital banks are competing with each other in order to serve customers better. As compared to Hong Kong, due to them not having a strong capital requirement, they may not have strong competition to do so. Another point is that digital banking are able to help SMEs that are not being adequately served by traditional banks. This could be seen with a Visa survey on Singapore SMEs, where 54% of respondents agreed that it will be a greater convenience when being served by digital bank, and 52% believe that it will reduce time and effort in transactions. Certain complex transactions like securing a loan requires SMEs to bring in sufficient documents in order to evaluate if they are creditworthy. However, if some of the SMEs who are just starting out do not have the sufficient documents, then it will be long-winded, frustrating, and maybe even denied. This reminds me in primary school where I forgot to bring the permission slip for a learning journey. Damn it, I want to go to the zoo. Instead, digital banks can use alternative data points to evaluate creditworthiness, which makes transactions faster and more effective. So because of how Singapore prioritizes SME more than Hong Kong in its economy, as seen with the differences in support for SMEs during COVID-19, Singapore economy can benefit greatly as SMEs can better scale up their business and expand their business because of digital banks. However, some say that digital banks can cause a loss of jobs due to automation and digitalization, as seen with industrial banks replacing 18,000 jobs for robots in order to increase productivity. This will lead to government stepping in order to help those who are affected, like giving stimulus checks. This is because those who lose their jobs require financial security in order to survive, especially during a crisis, which is a bad situation for both Hong Kong and Singapore. But although this may be true, we cannot deny the job opportunities that's being created by digital banking because of digitalization and automation. This is because the total number of data analytics and science jobs are expected to grow by 364,000 in the year 2020, which 19% of all these jobs are being demanded in the finance and insurance industry. It's that Ellen DeGeneres decided to give everyone a job opportunity. In fact, do you or not? Here. This proves that although there are reduction of jobs, it will be compensated with digital banking as there are new jobs needed to support new partnerships made and new competitors entering the market, which both supports Hong Kong and Singapore job population. For the third and last part of this video, I'll be talking about value destructive competition, where MES states that they do not want digital banks to engage in value destructive activities in order to gain market share. So what is value destructive competition? Well, it is companies or banks that are trying to gain a competitive advantage by destroying each other's value of product and services in order to gain benefits like increased profits and increased market share. The reason why MES wants to prevent this is because they want to protect traditional banks from having their business volumes or profitability being eroded significantly, and also to protect the long-term financial system stability. So one example of a value destructive competition is where Samsung, who is distributing their screens to Apple, if they are the only OLED screen makers in the market, and if they somehow raises their price significantly in order to destroy value of the iPhone from Apple, they will gain market share and profitability for sure, but it's a very destructive and unfair way of doing so, which could cause issues in the industry and for customers alike. So what is so harmful for the financial landscape if a bank were to gain market share through this value destructive competition? Well, if a bank were to engage in such value destructive activities, like for example relaxing their underwriting standards or underpricing risk, it could definitely pose a huge threat to the long-term financial system stability. This is because by unfairly destroying the ability of banks to maintain a healthy competition with each other in the industry, potential collapses may happen, and when banks collapse, it may cause a huge systemic risk in the financial system. One example is when in 2008, Lehman Brothers was too overexposed in the mortgage-backed securities, and because of this, they were unable to pay back lenders and thus filed for bankruptcy and collapse. They were among the key reasons why the 2008 financial crisis happened and why the global economy crashed as hard as Gibby over here. Furthermore, by destroying other banks' value and gaining market share and customers in such a dominant fashion because you are the best value, the bank is essentially creating a monopoly. This is bad for customers as there will be bad prices and interest rates for products and services because there's no competition to compete with them. And this is because the bank set a high barrier entry for them to do so. So this is essentially when a customer enters a bank and wants to open up a fixed deposit account and the clerk says, okay, here's the interest rate. And then the customer says, why is the interest rate so low? And then the clerk says, if you want, you can go to other banks. Oh, wait, there is none. Concluding this video, I think Singapore's decision of having digital banks is good, and I think that MES will strike the right balance between stability and competition. This can be seen with how Singapore requires applicants to have a sustainable digital banking business model in order for them to have long-term impact in the industry and not cause issues from collapsing. The overarching aim of digital banks is to make Singapore a more resilient, vibrant and competitive financial center while being anchored on financial technology. This is to provide Singapore a competitive standing in the world as a financial hub, especially against Hong Kong. Lastly, value destructive competition is what MES do not want in their banking industry, as it could cause systemic failures and also cause monopolization, which is bad for the industry and customers alike. Thank you so much and goodbye.